ExamPrep.School. Okay, Casualty Producer Practice Exam. There are 5 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Licensing, state insurance, statutes, rules, and regulations. State automobile insurance laws. State workers' compensation. Personal casualty policies and related terms. Commercial casualty policies, bonds, and related terms. Casualty insurance terms and related concepts. Casualty policy provisions and contract law. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following most accurately describes the primary purpose of Oklahoma's producer licensing laws? A. Ensure uniform premium rate filings across all licensed insurance companies. B. Protect consumers by requiring producers to meet competency and ethical standards. C. Generate revenue for the Oklahoma Insurance Department via licensing fees. D. Facilitate interstate commerce by harmonizing producer licensing requirements across states. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is to protect consumers by ensuring producers meet minimum competency and ethical standards, which is the core intent of Oklahoma's licensing requirements to safeguard the public interest. Reason A is not correct. Standardizing premium rate filings is managed separately under rate regulation and is not the focus of producer licensing. Reason C is not correct. Although fees support departmental operations, the primary goal of licensing is consumer protection, not revenue generation. Reason D is not correct. Interstate reciprocity is a secondary benefit. The main objective is to ensure producer competence and ethics. Question 2. Under 36 OS Section 1435.15. Within how many days after terminating a contract with a producer must an insurer furnish written notice of the termination to the insurance commissioner? A. 15 days. B. 60 days. C. 45 days. D. 30 days. The correct answer is D. The correct answer is 30 days because 36 OS Section 1435.15 requires insurers to provide written notice of a producer's termination to the insurance commissioner within 30 days of contract termination. Reason A is not correct. The statute allows more than 15 days for reporting termination notices. Reason B is not correct. The statute requires reporting sooner than 60 days after contract termination. Reason C is not correct. The statute specifies a shorter time frame than 45 days for submitting termination notices. Question 3. Under 36 OS Section 1435.13, which of the following is a valid ground for the commissioner to impose disciplinary action against an insurance producer? A. Failure to complete continuing education prior to license renewal. B. Conviction of a felony involving fraud or breach of trust. C. Charging a commission rate lower than that specified by the insurer. D. Maintaining duplicate licenses in multiple states without notification. The correct answer is B. The statute specifically identifies a felony conviction involving fraud or breach of trust as a disciplinary ground. The other actions are not enumerated in this provision. Reason A is not correct. Continuing education violations are governed by renewal regulations, not the disciplinary grounds listed in this section. Reason C is not correct. Commission rates are regulated by insurer agreements and unfair trade practice rules, not this disciplinary provision. Reason D is not correct. Holding licenses in multiple jurisdictions without notification is an administrative requirement, not a disciplinary ground under this statute. Question 4. Under Oklahoma law, which of the following most accurately describes the classification of a domestic insurer? A. An insurer organized under Oklahoma statutes, but with its principal office located outside the state. B. An insurer organized under the laws of another state, but maintaining its principal place of business in Oklahoma. C. An insurer organized under the laws of Oklahoma and maintaining its principal place of business in the state. D. An insurer established under federal law with its principal place of business in Oklahoma. The correct answer is C. The correct answer is based on the statutory definition that a domestic insurer must be incorporated or organized under Oklahoma law and have its principal place of business within Oklahoma. Reason A is not correct. Although organized under Oklahoma law, having its principal office outside the state disqualifies it from being domestic. Reason B is not correct. This option describes an insurer formed under another state's laws, which makes it a foreign insurer, not domestic. Reason D is not correct. No insurer is formed under federal law. Domestic insurers must be organized under Oklahoma state law. Question 5. Which of the following best qualifies as a foreign insurer under the Oklahoma Insurance Code? A. A reciprocal insurer established by Oklahoma policyholders and registered in the state. B. An insurer incorporated under Oklahoma law with its principal office located in Kansas. C. A non-admitted surplus lines insurer not incorporated in Oklahoma, but operating under surplus lines authority. D. An insurer chartered under the laws of California and authorized to transact insurance business in Oklahoma. The correct answer is D. The correct answer aligns with the statute defining a foreign insurer as one organized under the laws of any jurisdiction other than Oklahoma, such as another state, and authorized in Oklahoma. Reason A is not correct. A reciprocal insurer formed by Oklahoma policyholders is incorporated under state law and thus is domestic. Reason B is not correct. This insurer is incorporated under Oklahoma law, making it domestic despite its office location. Reason C is not correct, although non-admitted. A surplus lines insurer still organized under Oklahoma law would not be foreign. Question 6. A Canadian-based insurer has obtained a certificate of authority from the Oklahoma Insurance Commissioner to write casualty policies in Oklahoma. Under Oklahoma law, how is this insurer classified? A. Admitted alien insurer. B. Unauthorized alien insurer. C. Authorized foreign insurer. D. Domestic admitted insurer. The correct answer is A. The insurer is organized outside the United States, Canada, and holds a certificate of authority, making it an admitted alien insurer under Oklahoma law. Unauthorized alien insurers lack a certificate of authority. Foreign insurers are organized under the laws of another U.S. state, and domestic insurers are organized under Oklahoma law. Reason B is not correct. This classification applies to an alien insurer without a certificate of authority, but the insurer in the scenario is authorized. Reason C is not correct. Foreign insurers are organized under the laws of a U.S. state, whereas this insurer is organized in Canada. Reason D is not correct. Domestic insurers are organized under Oklahoma law, but this insurer is organized outside the state. Question 7. Under state insurance statutes, which of the following actions by a producer constitutes misrepresentation in insurance sales presentations? A. Presenting a non-guaranteed dividend as guaranteed. B. Failing to disclose that coverage applies only in certain jurisdictions. C. Offering a loyalty discount for timely renewal. D. Disclosing confidential policyholder information without consent. The correct answer is A. The correct answer is that presenting a non-guaranteed dividend as guaranteed constitutes misrepresentation because it involves a false statement about policy benefits. This violates state rules requiring accurate representation of policy features. Reason B is not correct. Failing to disclose jurisdictional limits relates to incomplete disclosure, but is not the specific misrepresentation of benefits. Reason C is not correct. Offering a loyalty discount is a permissible marketing practice and does not misrepresent coverage features. Reason D is not correct. Improper disclosure of confidential information breaches privacy rules but does not misrepresent policy terms. Question 8. Which of the following best exemplifies false advertising of insurance policies under state regulations? A. Claiming the insurer holds an A+ rating from an independent agency when that rating is accurate. B. Advertising a policy's deductible as higher than it actually is. C. Stating that an insurer will refund all premiums if no claims are filed without disclosing any conditions. D. Publishing a summary of policy benefits on the insurer's website with full disclosures. The correct answer is C. The correct answer is that stating a full premium refund without disclosing conditions constitutes false advertising because it omits material limitations, misleading the public about policy terms. Reason A is not correct. Accurate claims about an insurer's rating do not constitute false advertising. Reason B is not correct. Misstating a deductible is a misrepresentation of terms, but false advertising concerns promotional statements about benefits without qualification. Reason D is not correct. Providing a summary with full disclosures meets advertising requirements and is not false. Question 9. Under State Unfair Trade Practices Acts, twisting is defined as which of the following? A. Facilitating policy conversions solely for the policyowner's benefit. B. Recommending increased coverage limits to meet evolving risk exposures. C. Inducing a policyholder to replace an existing policy by misrepresenting the new policy's terms. D. Offering a premium financing plan to an insured to improve cash flow. The correct answer is C. The correct answer is that twisting involves inducing replacement of an existing policy through misrepresentation of the new policy's terms, which is prohibited under unfair trade practice laws. Reason A is not correct. Policy conversions for client benefit are permissible and not twisting. Reason B is not correct. Recommending higher coverage limits based on risk is appropriate advice, not twisting. Reason D is not correct. Offering premium financing is a marketing strategy and does not involve misrepresentation of policy terms. Question 10. An insurance producer posts on the agency's official social media page that a competing insurer routinely denies legitimate claims without investigation. Under the state's Unfair Trade Practices Act, which action can the insurance commissioner take to address this statement? A. Issue a cease and desist order requiring a retraction, corrective advertisement, and civil penalty. B. Suspend the competing insurer's license for a minimum of 30 days. C. Order restitution payments to insureds alleging wrongful claim denials. D. Refer the producer for criminal prosecution for fraudulent misrepresentation. The correct answer is A. The state's Unfair Trade Practices Act authorizes the commissioner to issue a cease and desist order, require a public retraction and corrective advertisement, and assess a civil penalty when a producer defames an insurer without factual basis. Reason B is not correct. License suspension is reserved for violations posing systemic risk, not for isolated defamatory statements. Reason C is not correct. Restitution payments are remedies for insureds harmed by claim handling, not for reputational defamation. Reason D is not correct. Criminal prosecution is not provided for in the Unfair Trade Practices provisions governing defamation. Question 11. Under Title 36 OS Section 3622, which element is not required for a temporary insurance binder to be legally binding? A. Name and address of the insured and the insurer. B. Description of the property or risk to be covered. C. Exact effective date and the specific expiration date of the binder. D. Documented proof of premium payment at time of binder issuance. The correct answer is D. The correct answer is documented proof of premium payment. Section 3622 requires a binder to be in writing, name both parties, describe the risk, and specify effective and expiration dates. But it does not mandate proof of payment at issue. Reason A is not correct. A binder must include the names and addresses of both insured and insurer under the statute. Reason B is not correct. A description of the property or risk is explicitly required to identify coverage. Reason C is not correct. The statute mandates stating the effective date and expiration date of the binder. Question 12. Under Title 36 OS Section 3622, absent earlier cancellation or replacement by a formal policy, a temporary binder automatically expires on the 20th hours on the 24th the 24 A. 90th. B. C. 30th. D. Point 112. The correct answer is A. The correct answer is the 90th day. Section 3622 provides that a temporary binder expires automatically 90 days after its effective date unless it is canceled or replaced sooner. Reason B is not correct. 60 days does not match the 90-day statutory expiration period. Reason C is not correct. 30 days is shorter than the statutory maximum duration outlined in Section 362.2. Reason D is not correct. 120 days exceeds the maximum binder duration set by the statute. Question 13. An insurer notifies an insured of intent to cancel a personal auto policy for non-payment of premium. Under the state's statutory cancellation notice requirements, what is the minimum number of days advance written notice the insurer must provide? A. 20 days. B. 10 days. C. 30 days. D. 45 days. The correct answer is B. The correct answer is 10 days because the state statute mandates at least 10 days of advance written notice for cancellation due to non-payment of premium on personal auto policies. Reason A is not correct. This period is longer than the statutory minimum for non-payment cancellations. Reason C is not correct. Notice periods of this length apply to non-renewals rather than non-payment cancellations. Reason D is not correct. Statutes do not require nearly this much advance notice for non-payment situations. Question 14. Under state insurance statutes, an insurer discovers that a commission payment is due to a producer whose license expired after the policy was procured, but before the payment date. In this situation, an insurer may legally pay the commission if A. The producer renews the license within 30 days after its expiration. B. The producer's license remained valid on both the policy effective date and the payment date. C. The commission was earned while the producer's license was in effect. D. The producer applies for license reinstatement within 60 days of expiration. The correct answer is C. State law permits payment of commission if the producer's license was valid at the time the commission was earned, even if the license expires before the payment date. Reason A is not correct. No statutory grace period extends commission payment eligibility after license expiration. Reason B is not correct. Payment law focuses on license status at commission earning, not requiring validity on payment date. Reason D is not correct. There is no allowed reinstatement application window that permits commission payment after expiration. Question 15. A producer holding a valid Oklahoma property casualty license, but not licensed as a surplus lines broker, places a commercial risk with a known admitted insurer and receives a 20% commission on the premium. Under state insurance regulations, is the producer permitted to retain this commission? A. Yes, because the commission is paid by the insurer for the producer's services. B. No, because only licensed surplus lines brokers may accept commissions from non-admitted insurers. C. Yes, if the producer discloses the commission amount to the insured in writing. D. No, unless the producer has an appointment from the non-admitted insurer on file. The correct answer is B. Only producers licensed specifically as surplus lines brokers are authorized to place business with non-admitted insurers and to accept commissions paid by those insurers. Reason A is not correct. A general property casualty license does not authorize acceptance of commissions from non-admitted insurers without surplus lines licensure. Reason C is not correct. Disclosure alone does not permit a non-surplus lines licensee to accept commissions from non-admitted insurers. Reason D is not correct. Non-admitted insurers are not required to appoint standard producers, So an appointment would not authorize a non-surplus lines licensee to retain the commission. Question 16. An Oklahoma personal auto policy has been in effect for 8 months when the insurer discovers that the insured intentionally understated annual mileage on the application in a manner that would have affected premium determination. The insurer seeks to cancel the policy immediately. Under Oklahoma law, which of the following is a permissible reason for canceling this policy? A. Insured reaches age 65, surpassing the insurer's preferred age classification. B. Insured intentionally understated annual mileage on the application. C. Insured has one at-fault accident after policy issuance. D. Insured's vehicle odometer registration expired and was not renewed. The correct answer is B. Under Oklahoma law, material misrepresentation on the application that affects underwriting or premium is a valid ground for cancellation. Other events such as age attainment, a single at-fault accident, or an expired odometer registration alone do not permit cancellation. Reason A is not correct. Age alone is not a statutorily permitted cancellation reason under Oklahoma automobile laws. Reason C is not correct. A single at-fault accident does not, by itself, authorize policy cancellation once the policy is in effect. Reason D is not correct. An expired odometer registration is not among the statutory grounds for canceling a personal auto policy. Question 17. Under Oklahoma law, what are the minimum compulsory automobile liability insurance limits for bodily injury per person, bodily injury per accident, and property damage per accident? A. $25,000, $50,000, $20,000. B. $20,000, $40,000, $20,000. C. $30,000, $60,000, $25,000. D. $25,000, $50,000, $25,000. The correct answer is D. Oklahoma statute requires liability coverage of at least $25,000 per person for bodily injury, $50,000 per accident for bodily injury, and $25,000 per accident for property damage. Reason A is not correct. The property damage limit in this option is $20,000, which is below the required $25,000 minimum. Reason B is not correct. Both bodily injury limits in this option fall below the required thresholds of $25,000 per person and $50,000 per accident. Reason C is not correct. Although the limits exceed the minimum in some categories, this combination does not state the exact required minimum amounts. Question 18. Under Oklahoma law, at what limits and frequency must an insurer present the offer of uninsured motorist coverage to a named insured? A. It must be expressly offered in writing at the same limits as bodily injury liability coverage at policy issuance and at each renewal unless waived in writing. B. It must be included automatically at the mandatory minimum limits unless the insured requests higher coverage. C. It must be separately quoted only when the applicant selects liability limits above the statutory minimum. D. It must be offered orally or in writing at any limits determined by the insurer's underwriting guidelines. The correct answer is A. Under Oklahoma statute, insurers are required to offer uninsured motorist coverage in writing at limits equal to bodily injury liability coverage, at initial policy issuance, and at each renewal, unless the named insured provides a written waiver. Reason B is not correct. This option is incorrect because uninsured motorist coverage is not automatically included. It must be offered in writing and may be rejected by a written waiver. Reason C is not correct. This option is incorrect because the offer is required for all liability limits, not only when limits exceed the minimum. Reason D is not correct. This option is incorrect because the offer must be in writing and at equal limits to liability coverage, not at insurer-determined limits or via oral presentation. Question 19. Under 85A OS Section 2, subsection 18, which of the following individuals is not excluded from the definition of employee for workers' compensation purposes? A. Litigious real estate broker paid solely by commission. B. Independent contractor hired to renovate office space. C. Part-time factory worker paid an hourly wage. D. Insurance solicitor compensated only by commissions. The correct answer is C. The part-time factory worker paid hourly is considered an employee under the statute, whereas the other options describe categories specifically excluded from the definition of employee. Reason A is not correct. Statute excludes licensed real estate brokers who work on commission as independent contractors. Reason B is not correct. Independent contractors performing renovation services fall outside the statutory employee definition. Reason D is not correct. Insurance solicitors paid solely by commission are expressly excluded from the definition of employee. Question 20. During her unpaid lunch break, a warehouse employee walked off the employer's premises to a nearby deli. While crossing the public street outside the deli, she slipped on an icy patch and fractured her wrist. Under typical workers' compensation law regarding injuries arising out of and in the course of employment, which statement is most accurate? A. The injury is compensable because the icy hazard was created by the employer's delivery operations. B. The injury is compensable since the employee's break schedule was dictated by the employer. C. The injury is compensable as arising out of employment despite taking place off the worksite. D. The injury is not compensable because it occurred while the employee was engaged in a personal errand off the employer's premises. The correct answer is D. Under the going and coming rule, injuries sustained during personal errands off the employer's premises are not considered to arise out of employment and are therefore not compensable. Reason A is not correct. The hazard was on a public street, not created or controlled by the employer, so it does not establish an employment nexus. Reason B is not correct. An employer's break schedule alone does not convert personal off-premises activities into compensable employment duties. Reason C is not correct. The off-site location severs the necessary causal connection between work duties and the injury for compensation coverage. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.